Hi everyone, this is Alan Rosenfield with Harmony Asset Management, and this is our latest edition of Thoughts and Comments. And normally this would be our Q1 2020 review, but if you don't know what's happened during the first quarter of this year by now, there is no hope for you. You've probably been living under a rock, and that was probably a good thing. No, the title of our video today is A Tale of Two Stories. We've stolen the idea from Charles Dickens, and as you'll see in a minute, the reason is because you've got two very different stories going on. There's the story the stock market's projecting, and the story that everything else is projecting, and they're completely opposite. Now, this is going to be a longer video than normal, and therefore we're breaking it up into sections, starting with the summary, and you can get the details in the next sections when you have time to listen. So in summary, we are in a recession. The US economy has lost 20 million jobs. Europe is a mess, so is Asia. But we will come out of it, and that's where opportunities come in. But it's too early now. Why? Because this isn't like prior recessions. And therefore, we don't know exactly how things are going to come out. CEOs don't know, scientists don't know, doctors don't know, nobody knows. So it's a little early to be speculating. The problem with speculating is the market's only down about 10%, yet earnings are already down much further. Therefore, valuations are even higher than they were a couple of months ago. So unless you get a V-shaped recovery, and that's highly unlikely, then stocks are too expensive. So now isn't the time to be buying. Now is the time to be preparing to buy. Looking at stories, looking at ideas, coming up with what you think are rational valuations, and then when stocks get there, you start adding them. The problem with committing now is if the stock market goes down further, now you have losses, but you also don't have any additional capital with which to buy at cheaper prices. So patience is a virtue. Now is the time to wait till we get more information and as you see valuations making better sense. We do in fact see one or two areas where there is a little bit of attractiveness now. It's still a little early, but we think there are a few places that you can start to nibble. But by and large, this is the time to be patient. Stay tuned for the details in the upcoming sections, and thank you for listening. So welcome to the first section of details on our thoughts for this upcoming year. I think an interesting and dramatic way to explain what I think is going on is by reading a passage, a very famous passage from A Tale of Two Cities. It was the best of times, it was the worst of times. It was the age of wisdom, it was the age of foolishness. It was the epoch of belief, it was the epoch of incredulity. It was the season of light, it was the season of darkness. It was the spring of hope, it was the winter of despair. What we have going on in the markets right now is a tale of two cities. One, we've got the stock market that seems to think that we're getting a V-shaped recovery and all is well. And then we have every other market that seems to think the market's nuts. So let's take a look. And let's start by looking at this first chart. This is year to date, comparing the S&P 500 to the 30-year treasuries. The purple are treasuries, the green is the S&P. So notice what happened. We had the market going down. It reached its peak on the 23rd, or its lows on the 23rd of March. The S&P was down just over 30%. And if you looked at other indexes, they were down as much or more. The Russell 5000, the Wilshire 5000 was down about 31.5%. The Russell 2000, which are the small stocks, was down over 40%. And then we've got this V-shaped recovery where we've gained back, we lost just over 30% and we've gained back 18 to be down just shy of 12% as of last Friday, May 1st. But when you look at treasuries, you get a very different story. And this is interesting. So normally, treasuries will move in opposite directions to the stock market. Risk on, risk off. When you're worried about stocks, you run to treasuries. When you're not worried about treasuries, you run to stocks. And now this is price action, not yield. So remember with bonds, when prices go up, that means the yield's going down. And when prices are going down, it means yields are going up. So they go down when you're selling out because you want to go into stocks, you're willing to take more risk on. And they go, and the prices go up and the interest rates go down. When you're scared of stocks, you start buying them and you're willing to pay more. So let's look at what happened here. Stock market starts down, bonds start up. Makes sense. Notice that the second half here, all of a sudden, stocks continue to decline. In fact, it happens more rapidly. And all of a sudden, bonds sell off. What's going on? What's going on is that you were getting margin calls. Investors were very heavily leveraged, and the margins calls all of a sudden, because of the collapse, said, you got to pay us back now. So they had to sell anything and everything. And that meant they sold bonds, they sold gold, they sold anything they could get a hold of because they had to pay their debts. Once that selling dried up, notice that stocks bounced back, so did bonds. But what becomes really important and interesting is what happened since then. So when you look at the next chart, which is from the 23rd, that low, until May 1st, see the green, the S&P, has jumped rather dramatically. But look what happened to bonds. They're actually up 1.4%. They didn't sell off. Bond investors are looking and saying, wait a minute, we don't buy in to this risk on. That's an interesting thing. Now let's take the next step and add gold. Same green and purple for stocks and bonds. The gold is gold. And notice what happened. Gold sold off like everything else did when the markets went through the final capitulation at this point. And then they rose again. And gold's up 12% this year. And gold was one of the top performing asset classes last year. But let's worry about that a little bit later. When we look at it, the next step in gold, which is from the 23rd of March, notice the same thing. Gold's up 9.5% almost in the time frame that stocks rallied. Now, gold goes up because you're worried about inflation, you're worried about the dollar, or you're worried about the economy, okay? And different things can set that off. But it's another safe haven. Your safe havens didn't sell off. People didn't say, oh, I don't need that. Let's go buy stocks. So the key here is what we're seeing is the big picture says other markets aren't buying into this risk on. Now let's take a deeper look into the bond markets. We're going to look at what we call spreads, okay? In the bond market lingo, everything is priced versus treasuries, which are considered your safest paper. So when you look at corporates, and here we have the gold is the treasuries, the green is AA paper. That's your very high quality corporate paper. And then Apple and Microsoft are AA paper. And then the purple is your BBB, which is the lowest grade that's still investment grade. And those are your safest ones. Now, this is from March, 2 months ago, before people were really too worried about the virus. And we're using this just as a point in time for a relative value of risk. Total spread between treasuries and BBB paper at 10 years was 185 basis points, or 1.85%. And the real key here is the difference between double and AAA was only 60 basis points, 0.6%. So to go from a AA piece of paper that was 10 years to a BBB, you were accepting only 0.6% more. In other words, you were taking on a lot more risk for very little extra gain. That's where risk levels were. Now let's look at it as of May 1st, last Friday. Total spreads between AAA and BBB jumped to 340 basis points from 185 basis points. And AA to BBB has jumped from 60 basis points to 160 basis points. Huge jump. So already bond players, corporate players are saying, wait a minute, there's a lot more risk with corporate paper now than there was simply 2 months ago. And when you look at the spread between the double and the BBB, the AA and the BBB, you went from 60 basis points to 160, 1.6% from 0.6. So about 2.5 times. Again, all that's telling us is people now see more risk with owning corporate paper, and they're demanding higher returns in order to buy it. At the same time, the stock market's saying everything's good. This makes us suspect. Our next area we're going to look at is the economy and the information we're getting from the economy and see how that jives with the stock market. Stay tuned. Welcome back. This is our second section where we compare the economy and the information we're getting there to what we're seeing with the stock market. I'm going to make a quick note, by the way. I want everybody to notice that I actually am not even wearing a sport coat today. I've decided, since we're all in hiding for the time being, I'd get my hair cut, I'd still shave, but I'm living on the edge. I'm not wearing a sport coat. I hope you'll forgive me. So, the economy. Let's take a look at the latest numbers that we're seeing from around the U.S., and then we can take a look at the globe. Right now, unemployment is the first factor. So between 2009 and 2019, roughly 21 million new jobs were created. We've lost almost 30 million jobs in the last month and a half. So we've wiped out growth from 10, 12 years worth of time frame. I guess that would be 10 years if you do the math right. Let's take a look at what this really means. According to the SBA, 43.5% of GDP comes from small businesses. And the average small business has about 10 employees. That means a lot more business is done. GDP comes from large businesses, but these small businesses are the ones that get hurt first. And it's harder for them to come back. The second thing that you look at is what the three largest sectors for these small businesses are. Number one is real estate. It's both development, but it's also renting and leasing. The second thing is retail, and the third area is manufacturing and mining. Again, you look around, what is it that's been closed and where are we going to see things get hurt first? Restaurants, small businesses of all types of services. So restaurants, beauty salons, barber shops, all of these kinds of areas are going to be a tough place. Retail of any type. All of this is going to be struggling. Many of them are closing. And the question is, will they open up again? It's too early to see. That's what we're waiting for. Most states are just talking about reopening now. So in the next 2 weeks, others like Illinois are going to stay closed the entire month. So we're going to have to wait and see what happens. Now, part of the issue is how have people's lifestyles changed. We know a lot of people don't have jobs. That means they're less likely to be spending it on going out to eat and going out for the basic pleasures because they're going to be watching their pennies. So this is the kind of thing that says to me, you're not likely to see a sharp change in the small business economy. So now let's look at the bigger business economy. We start looking at areas or sectors. Let's start with the travel industry. That's the obvious one that people think about. So that's hotels, that's cruise lines, and that's airlines. According to industry experts, a economic impact of this type typically, historically, takes 3 to 5 years to recover from. Let that sink in. And I've listened to interviews from the head of Marriott all the way to seeing things from some of the major airlines where they have warned that in 6 months, when their rescue money is gone, everybody's job is at risk. That says we won't necessarily know what's going on for 6 months. Now, if everybody jumps back on a plane and everybody starts traveling and staying in hotels and all of this, we'll be able to say, okay, it won't be so bad. But we don't know yet. We can't get the information. So let's look at Asia, where they are a couple of months ahead of us. And what do we find? We find they don't know either. They don't have economic numbers that are projecting out to 2021 yet. They're still looking and saying this year is going to be a recession. They don't know how long. They don't know how bad. They don't know what next year is going to be. They don't have enough information yet either. And they're a month to 2 months in front of us. Therefore, we're going to have to wait because we don't have any signs yet. But let's continue to think about what we're seeing. Look at other sectors, automobiles. Autos were slowing down already. It was time. They are cyclical business, and they had been selling peak amounts for a number of years. But now we're running into the issue that inventories are growing so much, they're having trouble finding places to put the inventory. There was just a report out of California that they finally let a ship in full of Nissans, and they've been renting parking spaces on a military base and at a fairgrounds so they could have a place to put cars. We'll have to wait and see if this becomes across the nation or this is just areas of the nation. But the point is, right now what we're seeing is that things are really slowing and we don't know how they're going to change. Let's look at the NFL. There's a simple situation where the NFL doesn't even start their season till September. Yet their CEO came out this last week and said that they are going to, as of this week, start having furloughs and pay cuts. Now, again, this is cautious behavior, which is probably wise, but it also says they're not sure what's going on. Remember that the vast majority of income for the NFL comes from TV and from merchandising. Merchandising requires people to be going to games. And the question is, will they? We don't know. All of these things point to the same thing. It's too early to be making a bet. And yet the stock market, as we've seen, has been skyrocketing. In the end, we could talk about others, the oil industry. There are a number of other industries, the transportation industry. We can look at all of these things, and what you're seeing is, across the board, most of them simply don't know. It's too early. Now, this isn't all bad. There will be sectors that do really well. There will be new things that come out in the way people change how they live. That's going to change industries and opportunities. So I don't look at this something to be scared of. It's simply something to recognize and say, okay, so we need to wait and get more information. But there are going to be opportunities. And we're digging into a number of areas that we think could be really interesting. The one we've talked to people about has been the energy. We still think it's early, but we think that's one of the areas where the stocks have, by and large, washed out. Not completely, because you're just starting to get bankruptcies, and that'll be the next phase that you see. Bankruptcies, Chapter 11s. You'll finally see wells getting capped. That's when we know that we really have gotten through the worst of it. But right now, we think there are opportunities to nibble, not take big bites in the oil with the very highest of qualities. So we'll find these in other areas too, but we'll get more aggressive when there's more information, and that's probably going to be after stocks are down a lot further. One last thing I'll note, just as another form of confirmation, this last weekend, Mr. Buffett gave his annual presentation. And he noted two things. One, he sold off all of his airline stocks. Now, the really interesting thing from this was where he said that he thinks their model will change, but he's not sure yet, so it takes more time. But he also said that given his age, he'll be 90 this year, he's not sure he'll be alive to see the change. Now, I don't think Mr. Buffett's saying he's about to drop dead. I think what he's suggesting is this is going to take a lot of time, folks. And the other thing he said is no, he hasn't bought anything yet. He's not seeing the opportunities. That's really another way to see confirmation of be patient. Our next area that we're going to discuss is going to be corporate earnings and debt levels of corporations. Stay tuned. Welcome back to our third and final section for our review of what we see going forward, our tale of two cities. And in this section, we're going to be talking about what the stock market is saying versus what earnings reports are saying. And this will be a fairly quick segment because the fact of the matter is you've only had about a third of earnings reported so far. So we don't have a lot of information there. I seem to be saying that a lot today, but those are the facts. Right now, what we are seeing is really the reports for first quarter, by and large, are not important. What's really more important is their guidance going forward. Very few companies, and there are a few that have guided forward, but most companies are simply withdrawing their guidance. They simply don't know yet. So why is it that stocks have rallied back so far when corporate CEOs are sitting there saying, oh, we don't know what's going to happen? They aren't saying that because they're looking out there and being really bullish. They're saying it because if they say anything and they're wrong, they're going to get into trouble. So they're not going to open their mouths. And there's just too much they don't know. Let's look at a couple of things that we have seen. By and large, companies all stopped their share buybacks. Now, while that was wise because they're scared about the cash flows and what's going on, it proves just how stupid it was to be doing in the first place. Because you buy it when stocks are cheap, not when they're expensive. And yet what they did was buy it when it was expensive, not when they were cheap. But you don't have most companies doing share buybacks. That was a major stool leg, if you will, in the stock market this last year. So you've removed that. Second thing is you've got a lot of companies with a lot of debt. They did it to buy stock. They did it to do dividends. They did all these things. And now they've got very high debt levels. And guess what? It's the debt level, the interest rate may not have changed, but guess what? Their cash flows did. They don't have the cash that they used to have. All of a sudden, people aren't spending money, so their revenues and their income are down, and yet they still have all that debt. Now, we have had the Fed step in and threaten to buy everything, and that's certainly supporting things. You've had the government come in and offer to bail out companies right and left. From an economic point of view, I think that was a major mistake. Corporations have something called Chapter 11. It allows them to operate while in bankruptcy protection so that they can reorganize and continue to operate. Most employees don't get laid off. Most employees don't find their pensions touched. But most shareholders find that they get hurt. But that's the risk of being a shareholder. And that's the problem we're running in today, is that the government's decided that nobody should take risk, or at least not the big guys. That to me alone says there's a lot of risk out there. Stocks are up, and yet there's no justification other than because somebody's going to protect us until they stop protecting us. That's a dangerous way to invest. Bottom line, now is not the time to invest, but now is the time to be planning on how you're going to invest. Now is the time to be preparing strategies, to be reviewing the strategies, to be getting ready. Whenever that time comes, whether it's in 3 weeks or 3 months or 3 years, really doesn't matter. If you've been defensive, you've got capital, you're already ahead of all those people that didn't. And if this goes down some more, and I think there's the risk of that, given what we've now talked about through the 3 areas, that earnings, we don't know where they are, but they're not going to be strong. Debt levels are high, that we're going to see more Chapter 11s and more defaults. All of these things say now is not the time to get aggressive, but it is the time to plan. For those of you that listen, that think, that stay patient, there are going to be some great opportunities. Stay patient, stay safe, keep checking back on us in terms of any new information we have. And if you have questions, as always, feel free to reach out to us and we'll be glad to discuss them with you. Thanks for listening.